Good morning. Glad you all could make it. My name is Paul Dippell, Company Service Leadership. We do several things for HTG. My business partner, Brian O'Connell, in the corner. If you happen to catch either one of us wandering around over the next few days, feel free to grab us and ask any questions you'd like. So I got into the solution provider business in 1983. I was much younger. And when I joined that company, it was 10 million in 2 locations, and over the next 7 years, we grew it to 130 million in 14 locations, and then we sold it to Pacific Bell, which was fun. And then I joined a $60 million solution provider, and we sold that about a year later to a company called CompuCom, which still today is the largest of the solution providers. We grew that from about 300 million to about 2 billion. That was fun. And then we did a turnaround, turned the solution provider around, sold it to Xerox, and then I joined a smaller company that we grew from 3 million to 50 million in about 24 months. That was fun. Then the internet bubble burst, and I said, I don't ever want to be working for somebody else again. Because if I'm going to suffer from somebody's mistakes, they ought to be mine instead of somebody else's. So I started this company 10 years ago to help other solution providers. Brian and I worked together in past lives, and Brian came on board in the company about 6 years ago. Today we're 10 folks. My wife is one of those folks. She was she started in the computer business in the late 70s as a key punch operator and worked her way up to be the CIO of a hospital group. She's the organized one, probably tell. And then she, about 15 years ago, retired. And then she got bored. And then she went to work wrapping Christmas gifts at Williams-Sonoma Cooking Store one year so that she could get the pots and pans and stuff inexpensively. And within 6 months, they had her as assistant manager, and 6 months later, they had her as manager. She's the organized one. And she was, about a year later, she was, store had closed for the evening. There was one employee there. She was up in the rafters moving some boxes around, and she slipped and fell off a ladder and landed on a concrete floor and shattered her right ankle. Everything's fine today. Took a lot of recovery, but everything's fine, thank God. So the internet bubble had burst. The company we grew from 3 million to 50 million didn't need me anymore, so I left, and then she fell off a ladder. So I was looking for a job, and she had fallen off a ladder, and we went, And thankfully, some people wanted me to speak in front of solution provider audiences, and so I started doing that, and somebody actually paid us to do that, which was really remarkable. Today, that's probably a quarter of our business, but it was a real shock at the time. And so she was in the living room on this hospital bed thing with her foot up like this when she fired up Quicken and put out the first invoice to the first customer that we had. And so today we're up to 10 folks. We work too much. We're having a good time. And she still runs the financial part of the company and the IT part of the company. So I asked her, what did she think might be on your minds this morning? And she said, explain why their husband is never home. And so that was her input. She also is pretty to the point. So much as I heard Robert say, one of the benefits to her is that she does go on a fair number of trips with me. I would say 2 or 3 times a year when I'm over in Europe or in New York or wherever it happens to be. We live in Dallas, and so that's why she's not here, because she doesn't want to come to the Hilton Anatole for any particular reason. Lovely hotel, though. So Rich said we're numbers guys. That's probably accurate to a degree, but our real expertise is in helping folks who own solution provider companies make more money and have more stock value. And for the first 15 years that I was in this business, I ran sales or service or whatever I happened to run, and I really didn't know anything about financial. And thankfully, reasonably successful. It was at the point that I realized how much better I could do if I understood how the financials worked that I started really learning about that. In addition, at the time, the company that I was with, we had 44 branch offices around the country, and branch offices are much like individual solution providers. There's a general manager in charge of making it grow and making it run right, keeping customers happy and keeping employees happy and all that. That general manager is in some ways, not completely, but in some ways like the owner of your companies. And when you're running 44 branches, you have some branch managers that are doing very well, some that are doing okay, and some that are not doing well, and that's not acceptable, right? Your job, particularly once we took the company public, your job is to get all the branches running well. Now, there's always going to be a rank of who's doing better, but having failing branches is not an option. And so what we learned how to do, and one of my jobs was to go around and doctor branches, help them be successful. And one of the things we learned to do is how to fairly determine whether they're doing well or not. And it's actually not that easy to do. You have to have a standard way to measure them financially, and then you have to get them to understand what that is so that they can look at the things that they can influence and go, yeah, I can do better at that or worse than that and all that kind of stuff. So the way we benchmark those branches is how we benchmark the members of HTG and a number of other solution provider populations. And it's basically for the same reason. It's to allow them to go, hey, for the way I run this business, how do I compare to other people that run the business very similarly? How am I performing profit-wise and growth-wise and all that kind of stuff? At any given point, I would say a third to a half of the owners that we deal with are more or less obsessed with beating those numbers. The other half, let's say, kind of go in and out of it, right? They're kind of like, well, I really want to get great results, but sometimes it comes in second priority or third priority to other things, and that's entirely understandable. The good news is if you put 100 solution providers in a room and you stack rank them by profitability, 1/4 of them will be making pretty spectacular profits. And 1/4 of them, unfortunately, will probably be breaking even or losing money, and the rest will be in between. If you look at the dividing line between the top 50 and the bottom 50, over the last 4 years, that's been about 7% profit. So for every dollar they sell, or every $1 million they sell, that's about $70,000 in profit, after they pay themselves a fair wage for the job. After they pay themselves a fair wage for the job. That's the median, the average. That's the dividing line between the bottom 50 and the top 50. The top quarter, if you count down from the most profitable to the 25th one and draw a line, that one will be making 18%, more than double the median. So fully 1/4 of the solution providers in that hypothetical room are making pretty dang good money, doing the same kinds of things for the same type of customer profile as the median ones and the ones that are not making that much money. So what is the secret of these guys as compared to these guys as compared to these guys? Because in this model, there's 3 times the cash coming out of the company every month, and there's 3 times the safety in terms of having some room to make mistakes or withstand errors of some kind, and probably 3 times the stock valuation if for some reason somebody should want to sell the company. May not ever plan to sell the company, but it's nice to have 3 times the value in case you do, right? So what are those best practices that get those folks up there? The answer is there's a bunch of different techniques you have to get right. That's a little intimidating. The great news is the best way to get them is to meet with other owners and find out what they're doing. Whether it's at HTG or another venue happens to be, I mean, we do a lot of consulting with these guys and we can help them out, But I think the best value they get is spending time with each other going, what did you try? What did you try? How did that work? How did that not work? Because this is what they call an execution-based business. We're not inventing new medical technologies. We're not patenting things. We're just doing better service more efficiently than other people. And so there's a lot of tricks to getting that right. And it's quite easy to spend time going down blind alleys, because there's no cookbook for this. There's no recipe, there's no handbook, there's no college you can go to do this, right? And so it's pretty easy to wander around trying to figure out what you should be doing. So joining a group like this that programmatically shares best practices and goes, how did you succeed, is huge. When we ran a company with 44 branches, we'd get all the general managers together twice a year and do exactly the same thing, because if you miss that benefit, you're at a terrible disadvantage competitively. So the fact that your spouses have joined this tells me they're smarter than the average bear to begin with. In our database, there's 20,000 solution providers in the US, and we probably have only captured about half of them. There are probably about 40,000 in the US, about 17,000 in Canada, if anybody is from our northern neighbor here. I would bet you fewer than 1,000 are in some kind of a group like this. So they're smarter than the average bear, in my opinion. They typically get better results. So this is about how to figure out what these companies are worth. My daddy told me a thing is only worth what you can get somebody to pay for it, right? And he was lucky enough to be able to build up some investments. He's 83 today and doesn't even remember anything about what I'm saying, but he was lucky enough to build up some investments, and then as he retired, he sold some of those off, and he had one piece of property left on a street. Actually, his father had bought it, and they had the property since 1927 on a little retail street in Los Angeles. And that was the last piece of property my dad had, and he'd been retired for years. And we thought it was worth about X, and everybody on the street thought it was worth about X. They all had the same plot of property, you know, same size, and everybody knew that X was the value to that. And my dad got an offer for 3X. And everybody on the street said, A, you can't sell because the Dippells have been here forever. It would be disloyal. And B, whoever's offering you that is lying. They're not going to pay that. And my dad said, well, that's okay. I love you guys as neighbors, but, you know, guess what? And the guy paid cash on the barrelhead, 3 times what everybody thought it was worth. Lucky? Sure. Smart? Okay. Right? So you want to be ready. I don't think he thought perhaps he was going to pass that down to my sisters and I. He didn't. I'm okay with that. He got a good deal on it. Right? So that's what this is all about. Before I go too much farther, I want to find out what questions you have on business valuation so that I can address those. I'm going to make this horrible noise. Watch the video, guys. So what questions have you? EBITDA question.
The T in EBITDA, the tax part.
I'm sorry, say again?
The tax part in EBITDA?
Yes.
Remember, I was told that it was on the tax return, on one of the lines in the tax return. Is that right?
The taxes that they're normally talking about adding back are payroll tax and state tax, not federal tax, usually. But the answer to the question is depending on who and how they prepared your tax return or your income statement, it could be labeled a couple of different ways. So you're asking because you want to calculate EBITDA?
Right. I do all the SLI reports, and I put all the numbers in and everything on a daily basis. So
Thank you very much. We're SLI, did you know that? Yes, okay.
I know Brian.
Oh, very good.
I email Brian all the time.
Oh, all right,
Question.
good. He is
Yeah,
the,
so that's the one thing. Everything else I'm good with, but that's the one question I always have.
where is that number? Where is that number?
You never get a straight answer.
So what I would do is, yeah,
From
yeah.
my group, I'm like, where do I get the T? Yeah, no.
Yeah, what I would do is get on a WebEx with Brian and let him look at your income statement that you get from, do you have a CPA to your income statement? Yeah, let him take a look at that and he can point out which components go in there. So great question.
Pull it from the P&L and then I could just pop it right in.
Right, so he'll be able to show you on the P&L where that is.
Okay.
Yeah, but it's at a couple different places. So
Tax and state tax.
yes, he'll be able to help you with that. So what she's talking about, EBITDA, it's too simple to say profit, so we say EBITDA, which is earnings before interest, taxes, depreciation, and amortization. What does that mean? When you get to the bottom line on the P&L or the income statement, the profit that's left over is after you pay interest, tax, depreciation, amortization. A buyer will look at your company and go, you know, I pay a little different interest rate than you do, I pay different taxes, I depreciate things differently, I amortize things differently, so I'm going to do one generous thing for you in this transaction. I'm going to let you add those things back to profit as when we value your firm. So EBITDA is profit plus those things that you spent money on added back in, just because their structure for that's going to be different and they'd rather not deal with yours. And the benefit of that is it helps you look more profitable a little bit. But it's one of those funny words that, if you don't know, sounds pretty weird. Did I answer your question, or I relayed you to somebody who can answer your question? You had a question?
Oh,
You did.
I did. When are we going to get data on shared infrastructure? We are primarily cloud-based, and when we sit in a room with all of our other members, they have so many questions because our business model just doesn't look like theirs.
Right.
It's very frustrating because our numbers actually don't compare with our room's numbers, you know, with the members
Right.
in the room. So when is that going to be a possibility?
So when you say data,
So we could compare with other cloud-based companies.
yeah.
Shared infrastructure.
Yeah.
So we don't compare with, there's not one single member
Right.
in our group that we compare with.
Right. So you are getting gross margin, you know that. So you're getting that, and you're getting your sales costs and so forth related to that for shared infrastructure. Okay, so you're already getting that. And then I think what you're asking me, to use one of our groovy terms, I think what you're asking me is when are you going to be compared to other people with your predominant business model of shared services?
Yes, exactly.
Okay, thanks, sorry.
Sorry.
So the answer is when we get enough of them.
How many do you have currently? Couldn't you compare them now?
15 or 20.
Wouldn't that be amazing if
Yeah.
I knew what they were doing and see where we compared?
It would be amazing, but I don't think it'd be reliable. I don't want to give that to you until I think we have enough of them for it to be reliable. So for
Still would be amazing to know. Just saying.
yes,
Be a beta.
yes, it would be amazing.
I'd be very pleased. I'm sure our group
Yes.
would be very pleased, so we wouldn't have to, every time we get new members, we have to explain why other things look very different. And
Yes.
it is something that sets back our group whenever our slides come up.
Yes, my apologies for that. So, how do I say this? We want to get to about 40 companies before we start releasing data on that, because otherwise I believe we'd be doing you a disservice. We'd be giving you misleading numbers, which are probably worse than no numbers.
All right.
So that's what we're doing. So we watch it, and we go, are we ready yet? Are we ready yet? But again, that's just, I'd rather give you good numbers. So the answer is, what I think I'd like to do, because I'd like to understand more about what you're running into, is if you would spend a little bit of time with me on the phone, and Brian would, and just take us through where you're running into concerns. So I want to make sure you may be seeing something that we can explain, that we can take off the list. So I'd be happy to help. And believe me, we'd love to have more. 4 quarters ago, we had almost none because there weren't people in that business model.
Right.
So
Well, we've been ever since we started the group, almost 4
well,
years
you
ago.
must be used to being ahead of everybody then.
But it's very frustrating.
Yes,
because
I can tell.
We don't know if we're going in the right
Yes.
direction. We don't know,
Yes.
it's great to see, that top tier, how they're getting 30% and, others might be getting 15%. What if we're doing that? We're spinning our wheels and we could be doing so much better. Someone has the secret.
I understand.
Damn it.
I understand. We're not keeping secrets from you. We're just trying to protect you from things that aren't secrets.
Seriously, my point is the purpose of what everyone is doing. If you're showing a really good profit in the top 25%, you're good.
But I don't even know if we are. What if we're not, I mean, realistically.
Yeah. Have you looked at the Bicometer?
Yes, and I'm not a superstar when it comes to all this. I just know that there's a lot of questions that we seem to be answering every single QBR. And then, when we do our QBRs, there's a lot of emailed questions. And it's just, it seems to be and it's designed around the fact that we're a shared infrastructure and they're not. Which basically it keeps coming back to.
Okay.
That's
Let's get together. Let's answer those questions
Okay.
because some of them may be real. Some of them may be things we can fill in the blanks on pretty easily.
Okay.
And let's make sure we show you the Bicometer. Best-in-class-ometer shows you the best-in-class for your specific predominant business model.
okay.
And it may be there, but we'll check it out. Excellent. I thought I was going to start with some fairly general questions on what is valuation. We started with EBITDA and where is my predominant business model? Thank you. Other questions? Any kind of questions? I could take it. I can take it. Okay. So, let's talk about business valuations. So, why is it useful to know the value of a business? We're going to cover what are solution provider businesses worth and why. How do you get them to optimum value? That's always fun. And how do you manage risk in the process? Like any investment, you have risk, right? And so how do you get maximum return out of this without creating undue risk in the process? So, and then your questions, which I'm happy to continue to take. So this business started more or less in the late 70s, early 80s. Right? When PCs came out, that's kind of when this whole thing started. And so this is the year that the solution providers in our database were founded. And there are some solution provider companies that were founded. We have one client who was founded, in fact, they're an HTG member, they were founded like 1910. They started as an office furniture company, and then they became an office equipment company, and then they became a PC company. And they still do all three of those things today, right? So, you can see more and more of these businesses were founded, and the peak was basically in the late 90s, leading up to the internet boom and bust, and fewer have been founded recently. I think that's basically because in this time frame, it was really hard to do poorly, because the IT business as a whole, the PC business was doubling, tripling, quadrupling every year, and so we thought we were really brilliant. Right, because we just keep getting spectacular results year after year. It wasn't really until this recession that the IT industry was hit. In these recessions, these red zones here, in these recessions, if you were in the IT industry, you just blew through the economy. I mean, you charged through the economy. No matter how bad it was, we were doubling, tripling. We were very, very smart back then. This is the first one where the IT business really slowed down as part of the recession, and it has this time, and that's because it's a much more mature industry. But what's interesting is 30% of the solution providers out there were founded 20 years ago or more, 15% were founded 25 years ago or more, which means there's a lot of folks in this business that have been in it for 20 or 25 years who are thinking about trying to retire one way or the other. Right? And so do you sell the company? Do you pass it to the employees? Do you pass it on to your family? What is all, so there's a lot of people thinking through this right now. And that usually brings an added focus on profitability because profitability drives value. So this is my assumption of where you want to go, or whatever your version of this is, philanthropy, teaching, traveling, whatever it may be. So I'm going to talk about how you value solution provider companies, and there's about 1 million ways to value solution provider companies because any given buyer has an idea what they prefer. I think I heard one the other day, this is about the most cockamamie one I've heard recently. was they count up the number of engineers and give you $375,000 for each engineer, whether you're profitable or not. Now I can go out and hire engineers for a whole lot less than $375,000 in recruiting fees, so I have no clue what they were thinking, right? I had no clue. They might have used eye color, would probably be better. They could pay. So there are a lot of different ways to value. I'm going to show you the most common one. I'm going to show you the one we use. But it's important to understand that sort of leading up to the internet bubble, we have these huge valuations, right? And then all of a sudden, boom, in 2001, you couldn't sell any company. You couldn't sell a solution provider company or any other company because nobody was interested. And we've been gradually climbing our way back. As I'll show you in a minute, we hit a peak in Q3 '07, then the economy stalled out, and we've been kind of fighting our way back. At the moment, companies with managed services, significant managed services component, are pretty much at the highest value they've ever been, which is a little bit surprising, but they actually are at as high or higher than they were in 2007. And all of that is being driven by a what's known as a market maker, which is that Konica Minolta bought the second largest managed service provider in the country, all covered, and then so a big company came in from outside the industry and bought one of the biggest players, and then Best Buy bought the biggest player, Mindshift, which was the biggest managed service provider to small businesses. So you get these two giant guys coming in from outside the industry with mountains of cash and bought the two biggest managed service providers, both of which were around 80 or 100 million in revenue. When that happens, values start to go up because they're going to keep buying, albeit they'll probably spend a little bit less on each subsequent acquisition. And that means that all the guys that are a little bit too small to be interesting to them are going to start buying in order to get bigger so that they're interesting to these guys. And the whole market kind of floats up that way. So it's an interesting time. So prior to the internet bubble, typically what you got valued on was some kind of relationship to your cash flow, how much profit you were producing, multiplied by some, what they call multiple, some value, plus strategic value. So Konica Minolta bought All Covered. All Covered, let's say they were making 10% profit, and let's say Konica Minolta spent 50 million on it. So 100 million at 10% profit is 10 million in profit. If Konica Minolta spent 50 million, that's 5 times that 10 million profit. That's a multiple of 5. Might they pay to 6 or 7 or 8? It's like stocks. I mean, you just make an offer and see if somebody will. Might they have paid over 5 or 6 or 7? They might have, because how else do you move fast and get 100 million worth of revenue in this business quickly? They could build it themselves. They could start a company from scratch, but they wanted to get moving. So they probably paid a premium. When Best Buy bought Mindshift, you could argue that Mindshift was better at the business than All Covered. Mindshift was bigger, probably more profitable, don't know for sure. They probably paid a higher multiple. Strategic value of buying the biggest player in the market and the most successful player in the market drives these strategic value multiples up, right? Because I can't, once I buy the first biggest one, the second biggest one, the next one's the third biggest one, not as much strategic value. I can't take as big a position in the industry as quickly. Does that make sense? Okay. When we got into the internet bubble, it switched from multiple of cash flow, multiple of profit, multiple of a proven business model. Because we were all hallucinating for some reason during the internet bubble, it switched to a multiple of revenue. I don't care if you really have profit, are you selling something? If you are, I'll give you a multiple of revenue. And we all went nuts. And then you remember the internet companies that went public with no customers, no revenue. That was a multiple of hallucination, right? So the market can do very strange things. The internet bubble crashed, and we went back to cash flow. Everybody went, enough of this ridiculous strategic value thing on the high end, let's just focus on cash flow. And it's pretty much been that way ever since. All right? So if we look at solution provider value, there are really two things that drive the value. One is what's called revenue visibility, which is how far forward can we see how much revenue you're going to make. A typical product-centric company or a company that does projects for a living as compared to managed services, if you look at their sales forecast, if you look at their sales funnel, typically you can only see 2 or 3 months out. And that terrifies most buyers of companies. I mean, I've seen them just turn white when they see that. And you just go, hey, somehow we're going to fill the funnel. We're going to do it. We do it every year. We've been doing it, every month. We've been doing it every month for the last 14 years. Trust me, the customers are going to be there. And they go, right? Managed services, on the other hand, is very visible. You have a contract for a year, 2 years, or 3 years. Good old time and material support, break fix was actually pretty predictable. But since you didn't have a contract, you couldn't prove that they were going to be your customers 2 years from now. On the managed services side, you can. And so managed service contracts provide a lot of comfort to people that are thinking about buying a company. They have a very high value because of that comfort. The other thing that drives value is how consistently can I predict how much billing my people will do. My biggest risk is my engineers because they're expensive, and if I don't keep them busy, then I don't make money, and then I lose them, and then my customers don't find value. So being able to predict how busy I'm going to keep them on billable utilization is a real key factor in valuing these firms, because that's where the profit is and that's where the risk is. So if you look at the different business models that we can be in, this is pretty much how they lay out, which is the product resale business has very low revenue visibility forward, and it's a tough business to figure out how to get engineers utilized. And there's a number of reasons for that I won't go into at the moment unless you want to, but folks that are good at selling product typically struggle to keep engineers billable and busy. And the primary reason for that is they're two very different value propositions, and they're different buyers within the company, and learning how to manage both those at the same time is tough. We do a lot of work with product-centric companies to help them make that progress, and it can be made, but it's tough. The next one is, well, I'm selling them product, so maybe I can wrap projects around that successfully. Projects get engineers billed, I can make more money on the service than I can on the product, and that has more visibility, and it has more utilization, so it's somewhat worth more. Then there is project-led product resale, which says instead of first attracting the customer by going, hey, I sell Cisco at a good price, you say, hey, we're the best guys to design and implement your Cisco network, and by the way, we can also sell you the gear. So you're forming the relationship with that service buyer and the customer, which sets you up to have more billable utilization. And because the project is planned by the customer before the product is purchased, if you're involved in the project, you know farther in advance when you're going to be doing it, and that gives you more revenue, more revenue visibility, and so that gives you more comfort that the pipeline's going to continue. Is this all making sense? Okay. Then you get to managed services. Now I have a 1 or 2 or 3 year contract. I know what I've committed to from a labor standpoint. I have very good visibility into the utilization that I'm going to get, and I do most of the work on site. That has great value because it's got good utilization, good margin, hopefully, and good visibility. That's great. The only problem with that is I have a pretty linear relationship between the number of customers and the number of engineers. That's not bad, but what I'd really like to do is be able to add customers faster than I add engineers, right? So I can add revenue before I add cost, and that's what the remote services allow them to do. because now I can serve customers in a more automated way without having to drive around town, and hopefully I can add customers faster than I add engineers. There's now evolving a business model that's beyond that, that has many of the same characteristics we call shared services, and this is where you build a data center and you move the client servers into your data center. Either you physically move them or you virtualize them or whatever you happen to do. And that can provide you with even more leverage, more customers without hiring as many engineers. However, there's a risk to that business model beyond this business model, and that is that if you spend the money on a data center and you don't get the customers to fill it up fast enough, then you haven't paid for a big mountain of equipment and space. And that's risky. So it potentially can reward higher because you can get some very high profit leverage, right? But it's also riskier. Yes?
The multipliers on your graph are applied to revenue
Revenue.
rather than profits, and so that was a switch in thinking in the valuations.
Yes, great points. Oh, she's pointing out, why did I say earlier we don't value on revenue anymore? And yet that's what I'm using here. We actually today primarily focus on profit, but also on revenue. And the reason that I wanted to use revenue here is because we're just talking business models, and I want to sort of correlate the types of revenue to the value, and then in a minute we'll look at profitability. Yeah, great question.
Where does infrastructure technical services come into play? Is that more project or in between?
Great question. Yeah, great question. Infrastructure technical services basically lives here. And the reason that we didn't put that on this chart is because there weren't enough room for that many bubbles. Most managed service companies came from the infrastructure technical services, not all of them. So this chart's more oriented towards where the business model is going. So some product folks are turning into managed service folks, some project folks are turning into managed service folks, but by the time we constructed this chart, a large majority of the technical services guys have become managed services, but it would live right between the yellow and green.
My other question is, what if your primary business model is a technical services and you're fairly profitable, and then you've got someone's primary business model as a managed service and they're not profitable? Which company would be more valued?
Great question. So first answer is always, what is the buyer looking for, right? But all of the things being equal, I would bet today the managed service company would be more valuable to more buyers because it's what's got the buzz, right? So cloud has a lot of buzz right now. And I know that because my mother called me the other day and said, she's 83, and she said, am I in the cloud? And I said, yeah, Mom, you use Yahoo Mail, you've been in the cloud for 14 years. And that totally baffled her. So, there are two kinds of buyers. There are strategic buyers and financial buyers. Financial buyers look at cash flow. And to take the extreme example, they don't care if they're buying a railroad, a solution provider, a yogurt stand. They have X amount of money to invest, and if it returns cash, that's what I want. So if you've got an infrastructure technical service business that generates a lot of cash and does it very well, like clockwork, and I can look at that and go, I'm pretty comfortable that's going to continue, and I'm a financial buyer, I'll buy it, and I'll pay good numbers for it, because I want cash flow for my investment. If I'm a strategic buyer, then I've got some puzzle pieces in mind that I want to fill in, managed services here, maybe some T&M here, maybe, that's what I'm up to, is putting some design together. Then it may not have that value, or it may. It may be precisely what I'm looking for.
Do you see more financial or strategic buyers out there?
In this industry, there's more strategic buyers. And the reason for that is financial buyers usually have a ton of money. And so they're looking for much bigger investments. They're looking to spend 100 million or 500 million at a time. You can find some financial buyers in smaller companies, but it's unusual. Now, there's a number of different plays. I'll give you another example. In the copier office equipment business, there are lots of office equipment guys that have been around for a long time that have thousands and thousands and thousands of customers on maintenance contracts and toner contracts that are very, very profitable. Nobody wants to buy those companies. They cash flow like crazy. You would die for the cash flow. They're not worth anything to sell. There's no market. You can't sell them. So these guys have $15, $20, $30 million businesses that put 15% of the bottom line like clockwork, and all you can do is put the money in the bank. They can't sell the companies. If they were managed service companies, they'd be worth a fortune. So all these copier guys are attempting to take and either build or buy managed service companies so that they can provide managed services to the copier clients and maybe copiers to the managed service clients. Wouldn't that be a wonderful thing? Likewise, somebody who's in managed services may look at you guys and go, you know, you've got a great base of customers that you haven't converted yet, and we've got some customers that might want some time and materials stuff. Let's get together. So that's thinking through the strategy of what are the puzzle pieces I want to put together, right? So you can, over time, you can develop a series of those scenarios and keep those in discussion with people who are potential buyers, and at some point one of them might go, that's a brilliant idea. You fit perfectly for that, right? And then you're strategic. So infrastructure shared services is typically up here, but you got to watch out for risk, right? Because you build a data center, you've got to sell fast enough that you can pay for all the equipment that you just bought, and then at 3 years, that equipment starts to be less efficient than the new stuff, and it starts to get hardware problems, and you got to replace it. So you have to sell fast enough. That's why you lease it with a dollar buyout. That's revenue valuations. Yes, sir. Okay. All right. And was that motion you made 10 minutes?
No,
That was, okay. All right. So now I'm going to talk about valuing on bottom line or adjusted EBITDA. You notice the revenue multiples here are up to about 1.2 times revenue. So $1 of revenue here might be worth $1.20. $1 of revenue here might be worth 30 cents. $1 of revenue here is typically worth around a dime. Dirty little secret though. The typical product-centric company is 4 times more revenue than the typical service-centric company. So even though the valuation dollar for dollar is smaller, they typically have 4 times as many dollars, right? So you got to kind of keep that in mind. So deal multiples for EBITDA have been improving slightly. That's what this clever chart shows. But I'm going to spend a minute. Have you guys seen this chart before? Does this make it back to you? Okay. So this is profitability from Q1 08 through the first quarter of 2012. This is all the solution providers together, regardless of predominant business model. Half made 5.8% or more, half made less. So if you had 100 of them in a room, you could say 5.8%, and half of them would break to that side and half would break to that side. But a quarter of them made above the marker here. A quarter of them made 18.6% or more. So 18.6% is the dividing line between the 26th most profitable one and the 25th one in that room. So that's 3.2 times as much. And the usual response that I get is, well, everybody knows this is the product-centric guys and this is the service-centric guys. Not true. That's the whole reason we do this predominant business model thing, is so that we can separate companies into similar business models. So here's product-centric. Over the last 17 quarters, the median product-centric company made 4.6% So half made more, half made less. But 1/4 of the product-centric guys made 13.3% or more. That's pretty good money. And this is all after the owner has paid themselves a fair market salary for being an employee, an executive in the company. Managed services, the median was 7%, and the best in class started at 20.1. So managed services still has the best in class. Your business model has the best median at the moment, shared services. So, but you got to be a little bit careful. If I was interested in just how much cash the company could throw off, I might build a product-centric company. If I wasn't interested in taking vacations, and if I wasn't interested in stock value, I'd build a product-centric company, maybe. Why? I'd rather be a best-in-class product-centric company than a median managed service-centric company. If this is a $5 million company, this company is putting almost $750,000 to the bottom line. This company right here at $5 million is only putting $350,000 to the bottom line. Follow me? So I'd rather be best-in-class product than median managed services if all I cared about was how much cash was coming out of the bottom of the income statement every year, especially when you consider that product-centric is 4 times bigger on average. But there's some disadvantages to the product business model. One of them is you can't go on vacation. Because in the product and project business, when the owner goes away, it goes like this, right? My dad ran his own company for 30 years, and it had nothing to do with this, but I remember when I was 10 or 11, we were on vacation somewhere, and I said, "Hey, Pop, how much did this vacation cost?" And he said, "Well, you mean how much are we spending to be here, or how much am I losing by not being in the office?" And I went, "Hey, let's go surfing." So it took me about 20 years to figure out what he was talking about. This is a much easier business model to go on vacation on. It ain't easy to go on vacation, but it's much easier because the customers are paying every month, right? The second thing is stock value. Dollar for dollar, this is worth, in terms of revenue, this is worth about 1/10 what this is right now. So if you're trying to build value, then you're better off services-centric, and you're definitely better off managed services-centric. Unfortunately, there are large product-centric solution providers, 40, 60, 80, 100 million, that really aren't worth a lot. Unfair? Yes. Hard to understand? Yes. Fact is, that's what's going on. So what I'm going to do is spend a couple minutes on a little tool most of your spouses have seen from time to time. So this is what we call the Solution Provider Valuation Approximator. I want to underscore it is called the approximator, not the exactimator. And when you go to our website and get this, it will ask you to say yes to this license agreement that says you will never use this for any business planning purpose or transaction whatsoever. This is an educational tool only. And the reason for that is I can't predict what a buyer will offer or what you'll say yes to. But we frequently get the question, if I want to increase my value, should I grow revenue or grow profitability? So let's take a look. Can you guys see this reasonably well? Okay. So here is a $2 million company, that solution provider, that is $600,000 in product resale, $400,000 in T&M services, $600,000 in project services, and $400,000 in managed services, putting 6% to the bottom line after paying the owner a fair market salary. And so this is what that same company would have been worth at different points in the past based on revenue valuation. So if you took the same company and magically transported it back in time to 99, this mix of revenue would give you 100,000 in value for the managed services, but in 2011, the same managed services would be worth 360,000. Why is that? Because back in 99, in the SMB world, nobody knew what managed services was, and nobody cared. On the other hand, the 600,000 in projects was worth 780,000 in 99, is only worth 315,000 today. Why? Because in 1999, every customer on the planet was spending money on IT like crazy to match growth, and so you should be in the product and project business. Woo! Great business model. Make a ton of money in projects. Engineers busy 24 hours a day. Customers can't get stuff installed fast enough. Today, in this economy, that's not a great business model, unfortunately. So it's not worth zero, but it's worth less. So that's the revenue valuation. This happens to be a little pie chart of where is the value coming from this year, right? But this is what it looks like on a linear basis or a year-over-year basis. The other way we're running a valuation here is based on EBITDA, and a $2 million company producing 6% profit would have these different values over these different years. And you can see we had a pretty high peak in 07, and then we dropped like a rock, and now we're fighting our way back. Okay? So what we do for this tool is we're sort of taking the revenue valuation in the current period, which this mix of revenue might be worth 823,000, and we're taking the EBITDA valuation in the current period, and based on EBITDA at 6%, this company might be worth about 291,000. And then we're averaging them together because a typical buyer might do both of those and then lump them together and say, what's the average? 557,000. Might you find a buyer that would only offer you 200,000 for that? Sure. Might you find a buyer like my dad found that would offer you 3 times that? Sure. If you got 100 offers, it's likely that they would be in a bell curve like this, and this number is probably somewhere near the middle of that bell curve, right? So the question comes up, should I grow the company, or should I just try and make more profit to make this more valuable? If we grew the company, well, I'll make one comment first. Because in today's market, EBITDA has more value than revenue, what we do on this little number right here, this delta, is we subtract the revenue value from the EBITDA value to see what the delta is between the two of them, see how far apart they are, and in what direction are they far apart. And in this case, there's a $530,000 negative delta between that 800 and that 300. There's a negative $500,000 difference. If I was entering into a negotiation with this seller, if this company was selling, I would point that out to them. Probably what they would do is go, hey, I've got this great business model because it's got 400,000 in managed services, and overall it's got 1.4 million in services, which is worth a lot, and so you should give me 823,000. And I'd say, yeah, but the profit model is really not working that well. 6% profit is basically median. Not bad, but if you want good financial value, and if you want good financial value, you want that profit number up. And if you want good strategic value, you probably want that profit number up as well, because high profit companies are usually doing things that are strategically interesting. They've put their own puzzle pieces together in a way that's producing unusually high results. That's interesting to me as a strategic buyer. Does that make sense? Okay. So this is not bad, but it's not great. So I would push back. If I was the buyer, I would push back and go, yeah, it's an interesting revenue model, but the profit model is just kind of median, and I would be pushing for a lower valuation. So if the owners of this company wanted $2 million instead of the average of $557,000, and they wanted to have more power, more leverage in the negotiation, how should they go about that? Well, I can go to $2 million basically by quadrupling these numbers, right? If I want to just grow to do that. So I can take this to 2.4. And I can take this to 1.6. I can try. And I can take this to 2.4. Whoa. And I can take this to 1.6. And by gosh, my average valuation is about 2 million between my EBITDA valuation and my revenue valuation. Now I quadrupled the revenue, but I'm a little bit more than quadrupled the value. The reason for that is the bigger you get some updraft in terms of multiples, right? But all I got to do to get 4 times the value, if I'm trying to do it through growth, is quadruple the revenue of the company. I got to go from 2 million to 8 million. That's a climb. It's absolutely possible. Absolutely solution providers that do it. I'd like a little more help, right? So what if I, for example, only double the size of the company, but at the same time I focus on profits? In fact, I'm gonna do better than that. I'm gonna set the whole thing back to where it was. Okay, so there I am with my $2 million company putting out 6% profit. That's about median. My average value is 557. I want to get to 2 million. I haven't rehearsed this, by the way, so I don't know where this is going to come out. If I got to best in class, watch this number right here. So I kept the size of the company the same. I took it to best in class profits, and I took my valuation to 1.37 million from 550,000. I got 3/4 of the way to my goal, and I didn't have to sell an extra dollar. Now, should you not try and grow the company? Of course not. Generally speaking, you do want to try and grow. But if you want to know how to drive stock value, drive profit, because that's what counts in the market today. Does strategy matter? Is managed services more appealing, have more curb appeal, to use a residential real estate term? Absolutely. But the ultimate curb appeal is this thing throws off cash flow and it does it every month. And part of the reason that I learned to read P&Ls and manage a company by an income statement and by the numbers is that if you can show an investor or a buyer sequential growth in revenue and sequential growth in profit quarter after quarter, year after year, that provides them with a lot of comfort. That's very interesting to buyers and investors, or lenders if you're looking for a loan, right? And that's curb appeal. That gets them to look at the company, and then it gives them comfort in the transaction. And when we talk deal structure, then that helps me a lot. Should you try and keep growing? Yes. Should you try and keep adding services revenue and adding managed services? In my opinion, yes. The great thing about focusing on profit is it not only helps in the valuation, but wouldn't you rather have $390,000 in cash at the end of the year than $120,000? Some people go, I'm not ever going to sell the company. Within reason, run it like you are going to sell it. And the reason for that is it requires great discipline, which is really healthy for the cash flow, which means even if you never sell it, in the intervening years, you put much more money into your back pocket. Even if you never plan to sell it, run it more or less like you are, because you'll put a whole lot more cash in your pocket. And should that crazy guy that showed up and bought my dad's property for 3 times as much as everybody said the market was show up on your doorstep, it's a very good day. Or should something change, you never thought you were going to sell the company, but something changes, that's the way life is sometimes, you have an asset that's worth a whole bunch of money. Questions? Useful? No questions? This tool is not available to members unless they spend $129. Do we have record of who's in this room, Rich? Do we have a list of who's in this room? You guys all registered, right? You're probably on a list of spouses. I'll make sure you get this tool. All right. Other questions? That was a good question, by the way. Got you a $129 tool. Got everybody in the room a $129 tool. Yeah. You need to buy her a glass of wine. Any other questions?
Wanted to know one thing. My husband's had his company for 16 years, and he's really considering selling it. And our question is whether or not the employees ought to be aware that he is thinking about putting the company on the market.
Yeah, tricky question. How many folks in the company?
There's 10.
10?
10.
Okay. So her question was, we are thinking of selling. Should the employees know? Really tough call. Generally not until the last moment. The buyer will, if they operate like most buyers and they're smart, the buyer will probably at some point just prior to close want to interview some of the employees. And that would be the point at which you release the happy news, wonderful. You're planning with the buyer, what is the message we want to send to people? We want the buyer to come in feeling positive and expressing things in a way that's culturally acceptable in your culture, right? And so that has to be planned very carefully. Very carefully. Other questions? Thank you for your time. I appreciate it. Hope it was valuable. Your spouses know how to get a hold of us. Many of you already know how to get a hold of Brian, so feel free to reach out. We love to talk to you guys and help out as much as we can. And we'll talk? Okay. Thanks.
Thank you. We got it.
Brought to you by the fine folks at Varvid, video and digital media for business. Contact us at info@varvid.com or online at varvid.com.